Welcome, everyone. Thank you so much for joining us. We're looking at the outperformance of international equities, what is driving the market, and is it sustainable? My name is Mary Machado Schammel, and I will be your moderator. I'm with Crystal Coalition Greenwich, and I have an esteemed group of panelists here that I'd like to introduce. Brandon Ahern, who's the Chief Investment Officer for Crane Shares, Taylor McKenna, who's an analyst at Copernic Global Investors, and Paul DiGiacomo, who's a Senior Portfolio Manager at Columbia Threadneedle Investments. And may I ask you gentlemen to maybe add a little bit more about your background and focus, as well as anything else that you'd like to add.
Thank you, very nice to be here. So I've been at Columbia Threadneedle for 20 years now. On our team, we invest in developed markets, ex-US, and so we do dabble in emerging markets as well. But we run a value strategy, a core strategy, and it was very interesting to be asked to be on this panel because for many, many years, internationals have performed U.S. For good reason. We believe going forward that the opportunity international is quite good.
Well, thank you for having me. I'm honored to be here with this team panelists. I work at a global value firm, and we're invested around the globe. And like Paul, we're seeing a lot of value outside the U.S. right now. I think what's really, really interesting is there's a study put out by Morningstar, and it showcased the outperformance of the international equities when it happens over the last 100 years or so. And there's been two instances where the valuations in the US have been at this extreme level relative to the international equities, and both times over the next 5 or 10 years, there was significant outperformance by ex-US. So that's where we're positioned today, and I'm looking forward to discussing.
My name is Brendan Ahern. My claim to fame was I got hired by Barclays at Global Investors. I moved to San Francisco at the beginning of 2001 when I started iShares. I was part of 24 people within the firm dedicated to that effort. Obviously, I had massive success. Unfortunately, our parent got into some troubles, so I moved back to New York, where I worked for BlackRock for a number of years. My background is really around indexing. My little joke is the most important book in finance is MSCI's Global Investable Market Index methodology, because those 200 pages dictate 17 trillion of assets, both active and passive, and no one's ever read it. So I got hired by our founder to kind of create our suite of ETFs based on my very boring knowledge of index methodologies.
Thank you so much. So as we have mentioned, we're looking at valuations outside of the U.S. They're looking at compelling opportunities for investors. And we'll be examining whether a new cycle of international outperformance is emerging, analyzing key drivers across developed and emerging markets. Our panelists will also discuss how these dynamics are shaping global markets and the strategic role of international equities alongside commodities within multi-asset portfolios. Before we get started, we wanted to just ask the audience, what is your allocation to international, including emerging markets? 5%? How many have 5%? Under 5%? 10%? 15? 20? 25? 30? 40? 50? Okay, great. Thank you so much. And then I also think we would be remiss if we didn't touch on the historic meeting earlier today in South Korea. If I could get your perspectives on the meeting between President Xi and Trump, I'd be most grateful. Paul?
I'm going to actually defer to Brent because you write that blog. So
Yeah, I mean, our largest fund, KWEB, we're the largest China ETF here in the U.S. And I read daily research, no China last night. But yeah, it's a trade truce. China will get the things that it needs from the U.S., which is semiconductors. They'll buy Boeing airplanes and soybeans. I think bigger picture, Trump going to China will do potentially a bigger deal, but it's a truce. It's not the grand bargain. It's a step in the right direction, and I think for all investors globally, if you think about your exposure to U.S. multinationals that are highly exposed via their China revenue, that's a good thing. And I think Trump is geared to U.S. corporate interests, and if it's Jensen Huang or Tim Cook or Walmart or Home Depot, he's looking at China not just through a defense lens, which is ultimately a good thing for all of us.
Etc. So, looking at our panel, why have international developed equities in Germany and Japan, as an example, outperformed for the first time in many years? Paul?
Well, it started at the beginning of the year. If you cast your mind back, it's more of a macro story than a micro one. Basically, if you look at what was happening here in the U.S., we were looking at restrictive policy. So we had the Fed had raised high rates, quantitative tightening. We had DOGE, which was going hot and heavy, and so on both sides, U.S. was looking to be restrictive. But then you look outside the U.S., and as Mary was saying, Germany was going to drop $12 trillion into defense and infrastructure. Japan is in a long-term governance reform trend, and they're shifting from deflation to inflation. And so what we saw at the beginning of the year was the U.S. lagging international, non-U.S. in local currency terms. Now all that changed post-Liberation Day, and when DOGE failed, because essentially Trump decided that if I can't fix the debt side of the equation, I'm going to go after the GDP side. And so this phrase, run it hot, we're seeing it more and more and more. And if you look at what's going on in the monetary and fiscal side in the U.S., it's very stimulating. I mean, we had Powell cut a quarter point yesterday. He's going to end quantitative tightening. I know his narrative was cautious for December, but he is under enormous pressure to cut rates. And then if you think about the fiscal side, the one big beautiful bill is clearly going to widen the deficit. Tariffs will be somewhat of an offset, but maybe those go away. So you're looking at some pretty hefty stimulus coming from the U.S. And so what's happened, the U.S. market has caught up, again, in local currency terms, but the dollar is depreciated about 10%, so the U.S. is still lagging. Now from here, hard to say, but it seems the scenario outside seems a little positive when we think about different countries that are able to pay their bills. And then here, there's a good chance inflation continues to rise, and the long end of the curve stays anchored high, and you have a steepening there, which is not necessarily good. So long diatribe, but that's where I think we stand.
Thank you, Paul. Taylor?
Sure. From our perspective, we're fully bottom of value investors. So if you look at the valuations, they were very subdued versus the U.S. So I think there's a lot of catch up that's going on there. And as my role at Copernic, I'm the mining analyst, and there's a lot of opportunities in the mining space right now. There has been historically. We were very invested in gold mining. We like gold for some of the reasons that Paul just explained. We think that those fundamentals are going to continue into the future, but gold has rallied a lot, and we're seeing a lot of upside in other metals, particularly platinum, which I'm happy to dive into.
The only thing I would add is, being in Europe a few weeks ago, Swiss institutional investors spoke about, they're not up 17% in U.S. equities, they're up 4%. the Swiss franc's been incredibly strong, so they're rebalancing. They're not taking U.S. equities to zero, but they are rebalancing. If you're a euro-denominated investor, you're not up 17%. You're up, I think 4%. I think it's 3% in the Swiss franc, 4%. In Japan, you're up 11. You just go down. I mean, we're U.S. people, so we think in dollar terms, but these foreign investors, there's money in motion, and we definitely see that happening because of the dollar's decline, fiscal irresponsibility in D.C., et cetera.
Thank you. And how about emerging markets? And maybe I will stop with you.
I think we're seeing money in motion coming back. I mean, this is 16 years of underperformance, and I think when people gave up on U.S. equities after 50% drawdowns in 2009, that was the base, and definitely to Paul's point, there's good reasons for U.S. equity outperformance, but some of it is just the index dysfunction. MSCI emerging markets was 50% financials and energy. In the case of China, it was 50% in those two sectors. MSCI China Tech went up 3 times the S&P 500 over those 16 years, but it was 2% of the index. So I think an element of this underperformance of non-U.S. equities is somewhat driven by these indices are not constructed to be transmission engines for GDP growth or GDP per capita growth. My favorite is Chile. Chile is the most stable country economically, politically in Latin America, and it's up 100% over 16 years, right? So we should have EMX Chile funds. But why? Because MSCI's definition is a handful of banks, copper and lithium stocks that have done squat, and so that's our focus, trying to find these growth opportunities. But I do think there's a regime change coming, and just this home bias in the U.S. It's really significant, and I think it's just starting to turn.
I know you hear that a lot down in Latin America, that there's a number of elections coming up.
Yes.
So, and Paul?
I would just say, in terms of how we're positioned in the fund, we're about as bullish on emerging markets as we can get. I mean, we can own up to 20% of the fund in EM, but we would never do that because then we would become an EM fund. But we're getting close to 10%, and a lot of it has to do with capital flows. Like you were saying, is that there's a lot of reasons why incremental capital is not going to be flowing into the U.S., and we're trying to figure out where else it's going to go. And if you think about the characteristics of a lot of emerging markets in terms of commodities heavy, and population growth, that kind of thing, we do believe that there'll be capital headed in that direction. So it's a fertile ground. There's a lot of cheap stocks. It's really quite interesting, actually. A long time ago, I read a paper where it said, in emerging markets, you really have to be cognizant of country, understanding the politics, the regulatory framework, that kind of thing. And in developed markets, it was all about sectors. Didn't really matter what country you were in. Well, I'm becoming more and more convinced that there are many countries that behave like emerging markets. You look what's going on in France, in the UK. Netherlands apparently is starting to have some political turmoil. You have to have a lot more attention to what's going on at the country level in developed markets than you ever have. So honestly, if you're an experienced EM investor, you actually have an advantage in the developed markets these days.
Yeah, and just to add to that, I feel like I'll be the outlier here, but we have about 40% of our portfolio in emerging markets right now. Nice. So we're able to see a lot of great franchises, and a lot of what Paul was talking about. The risk is greater when you're investing in an emerging market generally, and we assume a much higher margin of safety when we're investing there. But we're more being given that today. So we're able to buy great franchises in South Korea, Latin America as well.
Wonderful. Is that also, too, some of the resource companies that you're interested in?
Yes, that's true. So we're invested in a lot of natural resource companies, whether it be platinum in South Africa. We really like platinum. Platinum's historically traded at a 1-to-1 ratio to gold. over 50 years, and currently it's at a greater than a 60% discount to gold. And you're starting to see that play out. You're starting to see investment demand and jewelry demand growing. Actually, platinum is actually rarer than gold. It's owned by some central banks around the world, so it carries a lot of the same characteristics as gold. And then you also have to look at the supply side for all of these things. The current price in platinum does not incentivize new production. So if we go out 10 years or so, you're going to see a massive supply shortfall in platinum, unless prices move north of $2,000 an ounce.
Wonderful. And we've touched on a couple of compelling opportunities, but where do you see the most compelling opportunities in the developed markets outside of the U.S.?
I mean, I can start. I mean, we're very well, I guess, is Greece an emerging market? Maybe. Yes,
I think
until next September,
it's
right?
It's going to get upgraded, yeah.
I guess that doesn't count. It's tough because is Poland, I'm trying to think.
How about South Korea?
That's emerging though,
That's
isn't it?
emerging,
Yeah.
Depends on for
China.
FTSE, it's developed. So VWO holds South Korea, and EEM and IEMG, because of MSCI, it's still.
I think the audience is starting to question my professional competence. But no, if you had to put me in a corner, I'd say in continental Europe, Japan.
Right.
We're very bullish on Japan. Yeah, we're very bullish on Japan. So so on our team of three, Daisuke Nomoto is the best in the business. He focuses on Japan exclusively, and this corporate governance reform, people are aware of it, but I don't think they understand how important and of a backdrop it is to the companies. Daisuke likes to say that the Japanese corporates have lazy balance sheets, too much cash, a lot of shareholdings, management teams that are just too comfortable, just making time. And over the last couple of years, that's changed dramatically, where a lot of that is being unwound, and that capital is being either returned to shareholders or deployed in M&A, and we're seeing some enormously positive opportunities in Japan. Another thing that is important, I mentioned this earlier, was this idea of the shift from deflation to inflation, where Japanese households, you could put your money in a savings account earning nothing and be fine because the value of the value of what you own was going down. But if we shift to inflation, you're going to need to get more of a return on your money than you've had in the last many years. So that would incent money moving into the stock market, which has done very well. Retail tends to lag, so we just see flows going into the market on top of this corporate governance reform backdrop. So that took a while to get there, Mary, but thank you.
How about Germany, too? Do you see opportunity?
Yeah, we do. Well, I mean, the political backdrop is business favorable under Merz. I mentioned the $1 trillion are going to dump into the economy. The trouble that we're having is finding cheap stocks.
Yeah.
We are unintentionally underweight German industrials, and it's not for lack of trying. And we just can't get upside. And we part of our process is DCF driven, and it's a cornerstone of what we do. And we just cannot find cheap. Well, there are cheap businesses, but they're cheap for a reason. And we're too hairy even for me. So that's been really the issue in Germany. So a favorable backdrop, but I think a lot of that's priced in, particularly in cyclicals.
Yes. And others in Europe? Other countries of interest?
We're not, I think similar to Paul, we're looking hard in Europe, but we're just not seeing that many opportunities. We have some small holdings in Europe for sure, but outside of emerging markets internationally, we're seeing some upside in the Hong Kong market. Some of the big conglomerates are very inexpensive, and I'll point to CK Hutch. We think that many people, it takes a lot of work to value these companies because they have multiple businesses, and each business has multiple businesses. But what we can do at Copernic, we have a process where we're all industry specialists, and so each analyst can work on different parts of this business, and we can put it all together. So CK Hutchison offers a lot of value at current price. They've grown tangible book value per share for years.
So would
That's
you do
great.
like a sum of the parts or something like that?
Yes, yeah, yeah, exactly.
And the best ticker out there.
Yeah,
Number one.
HK.
And Brendan?
I mean, our emphasis is predominantly on Chinese equities, and we see, J.P. Morgan semi-annually has an institutional conference around the IMF and World Bank. They have 300 plus institutional investors, and they do a survey of what do you own, and then it runs. But they ask them, what do you do in China? And in April, it was 35% had zero China. In October, just 2 weeks ago, it was 41% have zero China. I mean, this is, forget year to date, go back to Jan of 2024 when Chinese equities bottomed, you're up, 60+%, and you own zero. Actively managed EM funds, 22% as of the end of Q3 have zero China. And in that JP Morgan, 7% are overweight China, looking to add, 2% are overweight China. So it's something like, 93% have basically neutral to underweight to zero. And I think the geopolitical headwind is the main contributor that, just from the pension CIOs, two of them have no discretion. They can't buy low because they're beholden to their trustees and their directors. And we just see, an improvement in U.S.-China relations under this administration, allowing this very significant underweight to come off. And institutions globally are the money's on the, China ETFs in Europe have had 6x the inflows year to date than the US. So what's the difference between them and us? It's because every day you wake up, the Wall Street Journal and Bloomberg tell you China is about to invade Taiwan or fall off a cliff, or it's just perpetually negative. And I think under Trump doing a deal, he can change that narrative, because you either loyalty and vindictiveness are probably, the two qualities that I think he, asked Mitt Romney what it's like to be a non-Trump Republican. You're not a Republican for very long. So I think he can dictate a change of the tone and tenor in Washington, D.C.
I think you're right. And if with your focus on China, could you make us, you can make a very strong case for China, if you don't mind.
It's cheap. There's a bevy of growth companies. This morning, a company called Tal Education reported results, and they absolutely crushed analyst expectations. I don't want to misquote myself. I forget what revenue growth was like 30% year over year, but the stock is 85% from its all-time high. I'm just like, okay, and then the revenues, earnings per share growth is higher than the all-time high. Revenue's not quite at the all-time. So there's no fundamental analysis. It's the sentiment. It's the geopolitical is what drives it, and there are risks. Don't get me wrong. You have to volatility adjust this, and but I do think this re-rating. There's a lot of money on the sidelines. It's just watching.
I think
agree.
just
Yes,
to add one
Taylor.
thing to that. As value investors, we're spending a lot of time in China, right? And it's a really unique time, and you can buy some of the best businesses in the world at substantial discounts. I'm talking about Baidu, which is the Google of China, Alibaba, which is all things China, right? These were trading at substantial discounts to their peers around the world, and they have phenomenal business models. So I think that there's a lot of opportunities there too.
I think kind of in your space, Taylor. I watch we're kind of growth-oriented investors, but I watch Zijing Mining, Ganfeng Lithium just had earnings a day ago, Northern Rare Earths. I mean, there's some, I think, some really interesting, plays on the commodity side within the Chinese A-share market and offshore.
No, there really is, and Zijin Mining, we would like to own it. It's been the best operated miner around the world. They've really ripped off their Western competitors over a couple decades.
That's wonderful. And Paul, on the emerging markets, where do you see opportunities? You touched on Greece, maybe.
Yeah, no, Greece took the pain after the GFC, and they're in really good shape from a macro perspective. And so, we do what we typically do where we're favorably disposed to a country. We own the banks. And so we own National Bank of Greece and Piraeus there. We also own Jumbo, which is a Greek, well, they used to be a toy retailer, but they're a little more diversified now. But the point is that the outlook there is quite favorable. Share your positivity on China. We have a few stocks that we own there. And then we do own a couple of banks in Brazil, which is a disaster. But our belief is that if things they don't have to get better, they just don't have to get a little less worse, and the stocks will work. So there's an opportunity there as well. We do own, we haven't really talked about AI yet. We probably will, but South Korea is certainly been a market on fire, partially to the Samsungs and Hynixes of the world, but also because of the heavy industry that they're very good at, and they're a trusted partner for Western democracies. So we have exposure there as well.
Wonderful. How about the frontier markets? Africa.
We're not. I thought you're going to go a different direction. Middle East. We own a property developer called Amar. They're in the UAE, but essentially they build luxury properties in Dubai, and there it's a play on the instability in developed markets where the wealthy are getting taxed more and more and more. And so Dubai's like, you can come here, it's a playground, we won't tax you, we've got golden visas, and you can protect your wealth here. And that's been a very attractive country for expats. And so that business has been on fire, but nothing in Africa, sorry.
FTSE announced that they're looking to upgrade Vietnam from frontier into emerging markets. That would happen in this, I think it's their September, I'm an MSCI person, not FTSE, but that'd be, I think, in their September 2026, barring a review in March of next year. But we see it as it's kind of like a China plus one strategy for a lot of global multinationals. It's got the demographics. It's in a good geographic or spot. So that's an area we're very interested in because of the potential upgrade.
Sure, we're always looking, and we have actually an investment in a frontier market, if you can call it Myanmar. It's Yoma, which really is.
Burma used to be.
That's exactly. So when we're investing in places like this, we need a very large margin of safety because it is very, very risky. But this is a very well-run company. The family's been running it for multi-decades. The son has just taken over. They're involved in the property sector. They're also involved in the consumer sector. They're in the retail sector. So as that country grows, it has a young population. As that country grows over time, they're set up to do very, very well. And we're able to buy them, from out of some of the parts at an 80% discount. So
because they're very commodity rich too, aren't they?
They are. Yeah, and it's very contested right now.
I know, right?
I think aren't they having a civil war?
Yeah,
They are.
And an earthquake.
Don't go there. Do not go there, Taylor.
I actually have been there.
Okay.
Right. So it sounds like there are many opportunities throughout the region, all the regions, really. We haven't really touched on Africa at all, but where maybe do you see certain regions that you're more focus on, I know by nature you'll be more focused on the Asia-Pacific area.
Yeah. I mean, I think to Paul's point, we see in Japan this reform up, in South Korea. Someone in the South Korean government read this Goldman report 3 years ago that if they did a bunch of reforms, they'd get upgraded by MSCI, and they would get, it's I think like 400 billion of. So they've tried to push through a Japan-like reform, and that's. It falls in and out of favor based on some of the political dynamics. And then certainly we see in China, you see a real emphasis on increasing corporate governance. They're running this anti-involution campaign of addressing excess capacity overproduction. We saw that today. I'm blanking on the big solar company. I wrote about it, but the largest producer of solar panels globally actually loses money, and they cut their loss in half year over year because the Chinese government is telling them you make all this revenue, but you lose money. So we see corporate. We see a lot of buying in the growth stocks. Where the CEO is either the founder is either the CEO or the chairperson, so the buyback yield on a lot of these companies is very, very strong. Tencent, Alibaba. We see similar kind of corporate governance, Japan-like reforms in South Korea as well as in China.
Right. And Paul and Taylor. Taylor, you want to go first?
Sure. I was just going to add that South Korea is our actually biggest allocation from a country perspective, and we go into it again from a valuation. If you looked at valuations going back 2 or 3 years ago, you could buy some of the leading telecom companies in that country for very, very low PEs. They're growing their market share. It's a population that's trading up. On top of that, you also had some of the big conglomerates like LG Corp on a some of the parts basis just trading at massive discounts. So as Paul said earlier, I like that quote. You just need it to go a little bit less bad, and stocks can work.
Wonderful.
Developed market benchmark that we adhere to, and that's 60% Europe. But as you can probably imagine, and from my commentary, that we're not as bulled up on Europe as we are in other parts of the world. And so if we want to be overweight other areas, EM, Canada, Japan, we have to be structurally underweight Europe. And so that's pretty much what we're doing from an asset allocation perspective, but that means that the stock selection has to be quite good. And we've been lucky in that way, in the sense that, going back to the very beginning of the discussion, having a macro view and positioning the portfolio to take advantage of that has helped us overcome, the significant underweight to German industrials, to European defense, to some other areas. European pharma is another area that's been very controversial. So from an asset allocation perspective, we're bullish on Europe, but less so than other parts of the world.
And this question, we've touched on many of the points, but AI and related commodity demand, increased defense spending are some of the factors driving this growth. So the sectors, I think we've touched on this, but if you'd like to expand on the sectors that you see the most opportunities and why. Again, you've already touched on some of those, but are there others?
Sure. I think within basic materials, you can make the case that a metal like copper does really, really well if the AI buildup doesn't happen to the extent that people are talking about. Copper is actually in a shortfall now. If you go out 10 years, there's no new big mines being built. So just in a normal situation, copper likely does well. But if you actually have a massive AI build out like's being planned and the energy transformation happens, you could see almost a copper on steroids scenario. So we're able to buy copper miners around the world at a reduced price right now in companies like Ivanhoe Mines and Lundin Mining in South America.
I would just say the AI thing is really interesting because your question is on sectors. 3 years ago, I would have said AI was a technology sector catalyst, but it's clearly become a global market catalyst because if you look at the CapEx that the hyperscalers are spending on these data centers and chips and the infrastructure around it, there are many, 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 many companies that are surprisingly beneficiaries of the AI theme. So I would call it a theme as opposed to a sector. And sometimes irrationally so. I mean, Taylor and I were talking about uranium before the panel, and both of us are very bullish on it. And it was all about nuclear power until the beginning of this year, and now it's an AI play. Was not expecting that. Was nice to know, but you really have to be careful these days in terms of understanding how the AI theme is invading the stocks you own, because, and now this is clearly not happening because last night and this morning we had Meta, Google, Microsoft, and Samsung, if you look at their CapEx and equipment, on the equipment side, all increasing their CapEx budgets. And I'm sure when Amazon reports tonight, their CapEx budget is going up as well. And you have Jensen Huang at the annual developer event earlier this week talking about 500 billion of orders in the next 18 months. Clearly, there's a lot of momentum in AI. Now, if that momentum were to slow, be very careful about how you're positioned. And this gets back to the initial question is should I have where should my allocation be, U.S. versus international? I would argue that the U.S. has become an AI play. The U.S. market is very narrow. We saw that earlier this week where the market was up, but it was driven by only 20% of the S&P was up and 80% were down. And so we do not have that concentration outside the U.S. We do have that exposure, but we don't have that concentration. And so if the AI theme were to falter, like we saw earlier this year, I would expect the U.S. markets to take a tumble. Obviously, international would go down, but certainly not by as much.
I think, I mean, to Taylor's point, Alibaba is the China AI play. They're 13% of their August revenue was driven by cloud computing. They're the largest cloud computing. Tencent and Baidu are kind of 2 and 3. So I think we see a lot of AI being applied within China to biotech. That the Chinese healthcare sector's done exceedingly well, and really driven by the adoption of AI. I think that's one of the contrasting is, in China it's all open source code. I mean, they're giving it away, and Stanford has this AI index, and the Alibaba's QN or Baidu's Ernie bot is right up there, and they're giving it away for free. Because so you have this very what's open AI if they're giving it away for free? Maybe not so much. So the other factor is the need for energy, and I don't know. I mean, who wants a nuclear power plant? When you fly into Hong Kong, you can see the nuclear power plant. And it's very controversial because it's literally downwind. I'm very skeptical of the nuclear, other than if we get to small scale, and that's where, to some degree, China. I mean, people aren't saying clean energy as an AI play, but in China, it's starting to happen because 50% of the electricity comes from hydro, wind, solar, and nuclear, and so they have abundant, cheap electricity because of renewables, including hydro and nuclear, and so I think we're in this self-fulfilling to try to justify valuations. They're certainly in China. Some of the semiconductor stocks are very, very expensive, and so I think you have to be somewhat cautious on some of the semi plays, just from a valuation perspective.
I hear you on the nuclear thing, and it's here in the U.S. in particular, in the wake of 3 Mile Island and a government regulatory body that seemed to be designed until the current administration to stop nuclear development. We had a lot of nuclear plants shut down post Fukushima in 2011. But what's interesting is that those are reopening, and we're seeing that there was news about Google and the plant in Iowa earlier this week. 3 Mile Island, they're going to restart one of their reactors. There's a plant in South Carolina that was mothballed that's coming back. And to your point on China, I forget how many they're opening. Do you know? Something like 10 a year. It's something ridiculous.
It's about almost 3 to 5% of electrical outputs in nuclear.
Right. Yeah, and so it's a theme that had catalyst before the AI, and which is why we were very bullish on it. And now it's more about, there's a lot of exuberance there, and being valuation centric. Again, Taylor and I were talking about this before, is that you have to be rotating out of these things. And so, this business always teaches you humility. I don't understand how people in this business can be arrogant, but so we own Cameco, which is the largest Canadian uranium producer. They bought Westinghouse 2 years ago.
3 years ago.
Yeah, and we sold it 2 weeks ago, and 2 days ago they announced a deal with the U.S. government to build 80 billion of nuclear power plants. Stock was up 25%. So I'm more gutted about that stock than you can imagine. It's just, but you got to stick to the discipline of the process. The value just wasn't there.
Well, if it makes you feel better, we sold it earlier than you.
Okay. It doesn't, but.
So have investors missed the opportunity, or is this sustainable with more upside ahead?
Like I said earlier, when valuations get this out of whack historically, U.S. versus global, the next 10 years for global international investing has been very, very good. So the valuations are still very, very low relatively. So I would assume that this is only the start.
Yeah, I mean, valuation is certainly incredibly important. I totally agree. And the one thing that we need is a catalyst, and we're starting to see it. And it gets back to the macro discussion we were having earlier, where relative to what's going on in the U.S., which is certainly propelling the market forward today, and you look at, we can talk for hours about this idea of dollar debasement and whether the U.S. dollar and the treasuries are no longer are becoming less of a global reserve currency and store of value. But if that continues to degrade, then that could be the catalyst that keeps this going.
Yeah, I think about a year ago, the Wall Street Journal had this article about the Fidelity Freedom Funds and how badly they had done. And the only reason I know anything about it is because the Connecticut 529 plan is run by Fidelity. Why did they do so badly? Because they were diversified internationally. And the article was making fun of the portfolio manager and saying, you idiot, how do you not own, why do you own these non-U.S. stocks? And then they had all these it was crazy. These people were quoted being like, yeah, it's stupid to hold non-U.S. And I just thought that was, they don't ring a bell, from our interacting with institutions, we've developed a very institutional, very global investor base, and we are benefiting from the money in motion. And I don't see it as a zero-sum game. I just think when you have this perpetual 16 years, just quarter and quarter and quarter, things get whittled down until they're gone. And your B of A's Harnett, he talks a lot about he's gold, international, and then he always puts but nobody internally takes my advice. I mean, the allocations within wealth to non-U.S. is zero, basically zero, and you're like, okay, the market will do what's people are least prepared for.
So the message is diversification. What would you say is the ideal allocation for international equities, including emerging markets?
I mean, within ACWI, the U.S. is still like 61%. If you GDP weight ACWI, it starts to look different. But yeah, I just think, just kind of going on, and again, you can't take U.S. equities to zero. People don't want to pay taxes. I don't want to pay taxes. I've been in the ETF world forever. And I have these, I'm not going to sell those positions because I don't want to pay taxes. But new money, I think, will definitely, for personally, is being put into non-U.S. equities. And I see that kind of, potentially that happening out with institutions outside of the U.S. much faster than domestically.
So given the valuations and such. Paul and Taylor?
Sure, I would say there's a similar tune. I mean, the 61% is interesting, but what's also interesting is in the MSCI, the U.S. is 40% of the earnings, and it's 60% of the market cap. And usually these are much closer together than they are now. So it's again, speaking to the overvaluation here in the U.S., we're benchmark agnostic, so we'll be invested outside the U.S. As long as we're seeing more value there. And it's not because we don't like the U.S. These are fantastic businesses, but it's purely from a price perspective.
Yeah, I get this question a lot when I'm talking to clients, and I wish I knew that 40%. That was a good statistic. But you have to invest with what your risk tolerance is, and typically is a home bias. It's one of the psychological biases we see and the behavioral biases we see in this industry. And so I understand if clients are hesitant to go overseas, but there is a good case to be made to have more of your capital overseas than in the U.S. And so I don't know what that number is. Is it 10%, 20%? For me, it's 60%. Of course, I'm a little biased. So.
Thank you. So we want to have time for questions, and maybe after that, your forecast for 2026. But let's first take some questions from the audience. Yes, one moment.
Okay, Brendan. So I finally found someone who can answer a question I've been asking for years. Why is China still classified as an emerging market?
Because MSCI's definition is driven by GDP per capita, which means it will never be a developed market.
Yeah, because of the denominator. Right?
Yeah.
So do you agree with that? Having worked on these indices, do you agree? Is that a solid methodology? I mean, it's the second biggest economy in the world. They're dominating some of these industries we've talked about. They have a plan.
That's a tough one because in traveling to China, I go to Beijing, I go to Shanghai, I'm in Hong Kong, I take the high-speed rail up to Shenzhen, and I'm in rich China. And I have gone out into the hinterland, and China got real poor real fast. So I think the way to think about China is these tier 1 cities are developed markets, but a large swath of China geographically, a large element, even with the urbanization trend in China, you have a lot of China is significantly poor. And so I don't know, and even you see them play it both ways. Like sometimes they're a rich country, sometimes they're poor. So yeah, it's but I was just in like South Korea for work. I mean, traffic worse than here in LA. Like literally you need like 3 hours to get out to the airport. But that I was like, man, this is a developed market. More than half of the country lives in Seoul, and that I was like, this is a developed market. Just on I don't care what GDP per capita says. Yeah.
Any other questions? Let's pivot to. Excuse me. Go ahead.
Yeah. You mentioned Japan is having some pretty good prospects. And like 30 years ago, 25, 30 years ago, is a larger market cap than the U.S.
Yeah.
And today, nobody has a dedicated exposure to Japan, either through the advisor network or institutions don't have it. and it's like the fifth largest economy in the world behind California. Do you think either Japan, obviously China deserves a dedicated exposure with its size. Are there any other countries that you think an investor would be well served having a dedicated exposure rather than a broad exposure?
I mean, it's what we've kind of discussed. We don't do India because it's always expensive, but that's obviously a market with a lot of momentum. What's interesting about the country level funds, we do have a Japan fund. Daisuke manages it. We've got about $3 billion in it now, but it's a London listed vehicle, so it's not available to U.S. investors, which is too bad. But it is very narrow, and so you would know more than I in terms of the interest in country level funds.
Yeah, it's few and far. Listen, for non-U.S. equity, it's been a tough place to hang your hat. I won't name the fund families that basically have crashed on the rocks, but there's a whole host of our peers that are a mere fraction of what they used to be. I'm talking 80, 90% drawdowns. They're going away. And so, yeah, it's Japan. I do think Japan is very interesting because of this reform up. The year Japan started shrinking demographically was the bottom of their bear market. They're an exporting country, so they're not domestically geared. But it's tough. It's tough. We have an EM version of our China Growth Fund. By Morningstar, we're literally the top decile. For the last year and a half, we just got kicked off one of the major wealth management platforms. And we were like, "How do you kick the number one fund off?" And they're like, "Well, you have no assets." It's like, okay.
Yes. You mentioned Vietnam as being upgraded from frontier to emerging. Oh, I was just there this summer, and it reminded me of South Korea, like late 1980s, early 90s, when I had visited. I was curious what you saw were some of the tailwinds in Vietnam.
It's a China plus one play. It's a demographic play. It's Nike's moved a lot of their manufacturing. It's cheaper than China from a labor perspective, but the government is investing in infrastructure. They're going to put a high-speed rail between Saigon and Ho Chi Minh City. So yeah, we see it. It's a tiny market cap. You almost got to temper your enthusiasm. I think it's only like 150 billion U.S. in aggregate market cap. But FTSE is doing the upgrade because MSCI hasn't done it. FTSE upgraded South Korea in, I think it was like 2012, and MSCI still hasn't done it. So the main institutions benchmarked to FTSE are CalPERS and Vanguard. So you can front run John Bogle and by buying some Vietnam stocks.
I don't have an opinion on Vietnam, but I have a framework in how to look at it, and I'll do this after this discussion. But we have, when you look at our investment process and how we run the fund and build the portfolio, it looks like a Venn diagram, and there's a macro circle, there's a quantitative stock selection circle, and there's a fundamental analysis circle. But within the macro model, we look at the cost of doing business. And so when you think about that in very broad, high-level terms, it's the cost of capital, the cost of labor, and the cost of raw materials. And so if I were to look at Vietnam through that lens, that's how I would do it. And so cost of labor, what you were saying, low, right? Cost of capital, I don't know what their rates are, but could be low. And, the cost of raw materials, that's really out of their control. And you could argue that everyone is faced with that same dynamic. And so if you can get comfortable with, with their cost of doing business, we have found that when it's lower, countries tend to relatively outperform over a long period of time, obviously. But that's how I would look at Vietnam if I were going to go wading in with both feet. Just now I'm kind of interested. So,
any other questions?
one more.
May I, let me, just back here, I think you've had his hand up.
I can just be loud. I can just be loud. I'm curious for thoughts and ideas. Thanks. Sure. Curious for ideas around minerals and rare earth opportunities in the international markets. Obviously, we have, I guess, something of a détente news this morning, but are there countries or opportunities that you're seeing in terms of particularly the processing of heavy rare earths?
Sure.
And it's a little niche.
Yeah.
Right up here.
Rare earths are tough because they're only really mined in a few locations. Obviously, China's the largest, right? So there's other countries that are trying to do this. I think there were some great deals signed with Malaysia in the past week. When it comes to critical minerals, there's a lot more opportunities than there are in rare earths. So we're talking copper. There's a lot of great copper deposits in South America that are on sale. Lundin Mining, like I mentioned. Ivanhoe Mines has just a phenomenal mine in the DRC. So I would almost, in a way, focus your attention there. Nickel's also very interesting at this price. Rare earths are in the news, but they're very hard to play. Right? There's really only a handful of public companies. Some of them are A-share listed in China, which we're not able to invest in. Then the couple in the U.S. are very, very expensive. So there could be more opportunities there in the future, but I think there's other larger opportunities now.
Yeah, I regardless of Trump-Xi truce treaty, I think the rare earth demand. The next step that hasn't happened is the robotics. That you're on this precipice of AI going into humanoid robotics. Morgan Stanley's auto analyst Adam Jonas doesn't believe Tesla will be an auto company in 5 years. They'll just be a robot maker. And so we see this is going to create a lot of demand for rare earths. So there's Linus in Australia. There's a company called Ilkua. I think they're Finnish. They do have unsponsored ADRs that trade, but definitely look at a Bloomberg, do POD, because Linus was at a 20% premium to its the local Australian listing about a week ago. But part of I think that ultimately with rare earths, it's the processing is so environmentally bad that we're so blessed that these people are so poor that they're willing to turn that geographic area into a wasteland. I mean, I'm sure you've been up to the oil sands in Fort McMurray in Canada. I mean, to process oil sands, you turn that part of Canada into the dark side of the moon. And so this idea we're going to be processing rare earths here in the U.S., I take the under. You want to be downwind of that? Heck no. See what, anyway, so it's the processing, the environmental consequence is horrific. And that's why it's never coming back. Maybe, Linus, they have this thing called the Outback. Like, they'll do it out there, but, I really hope, and no one thinks that they want to do it that here.
I have a different point of view on that. I know we're getting to stop, but I can't leave it with a rare earths negative. So we own a company called Energy Fuels. It's listed in the U.S. and Canada, ticker UUUU. Stock has been a rocket ship because we bought it for the uranium. It's a domestic producer of uranium. And the CEO, I thought, was a little off when he decided he wanted to go after rare earths, but clearly he's being proven right. But what's interesting about this company, MP Materials is another one, is that they have what's called the White Mesa Mill, which is their competitive advantage, their moat, and it's the only approved mill to process first uranium, and then they've gotten approval to process light, and they're going to get heavy rare earths. So there is a way to do it without destroying the environment. But I do agree. I mean, that's why the opportunity is there, is that China has cornered the market in rare earths processing, and now it has become a critical mineral for the United States and other Western democracies.
We have lab-grown diamonds. Why can't we have lab-grown rare earths? I mean, I think I'd rather see the money, our taxpayer money, go into trying to incentivize the people in the lab, to create something rather than, MP. I mean, to me, it's the next Salandra. I'm very skeptical.
I hear you, but we need rare earths now. I mean, the whole reason why China has leverage over us is because she decided to withhold rare earths from our defense and technology industries. We don't have the luxury of figuring out the lab. So yes, we have to make sacrifices to the environment, to the cost, to get this securely in our hands. So we can't be leveraged in the way that China has, which has totally blunted Trump's foreign policy, in quotes.
So I know we're beyond our time, but may I ask you just for your final thoughts and maybe a prospect for 2026 too, for international equities?
I think the outlook is quite bright. We've talked a lot about it. I mean, but basically, I don't see the situation in the U.S. changing if the AI bubble were to start to deflate. And given the monetary and fiscal accommodation that we're getting here, I just think international is going to rip relative and probably absolute as well.
Sure, and we talked a lot about this today, so I won't get too far into it. But if sticking to the platinum theme, I think Valterra Platinum has incredible value at the current price, and I think platinum needs to be north of $2,000 for the industry to work long term. In that scenario, Valterra has multiple upside from here.
Yeah, I mean, we see a re-rating in non-U.S. equities, including EM and China, and we think particularly on the China side, there's a very, very significant underweight, particularly from U.S. institutional investors, and that cash on the sidelines, just a little smidge of it coming back, it can move the market.
Well, please join me in thanking our wonderful panel.